$4.37 just landed in someone's account. They did not work for it. They did not log in, check anything, or make a single decision this morning. They just woke up and it was there. Now, before you think that sounds too small to matter, here is what you are missing. That same person started with less than $100. And that small payment you just saw is now part of a system that pays them every single quarter without fail. Whether the economy is good, bad, or completely unpredictable. By the end of this video, you are going to know exactly how that system works. And more importantly, you are going to know how to start building your own version of it this week, even if all you have right now is $50 and zero investing experience. Stay with me, because the first thing I need to show you is why most people never even start, and it has nothing to do with money. Here's what happens to most people when they decide they want to start investing. They open Google. They type in something like, how to start investing with no money. And within about 4 minutes, they are completely overwhelmed. ETFs, dividend yield, expense ratios, portfolio allocation, rebalancing. They close the tab. They tell themselves they will figure it out later when they have more money to work with, when it actually feels worth it, when things make more sense. And later never comes. Sound familiar? Because that is not a discipline problem. That is not a motivation problem. That is an information problem. Nobody gave you a simple starting point. Nobody showed you that you do not need thousands of dollars and a finance degree to build something real. And here is the belief that kills most people before they even begin. I do not have enough to make it matter. That belief is the most expensive thing most people will ever hold on to. And by the end of this video, it is going to be completely gone. But first, there is a myth about dividends that I need to destroy right now. Because if you believe it, everything else I tell you will not land the way it should. Let me kill the biggest myth in dividend investing right now. You do not need thousands of dollars to start. You do not need a financial advisor. You do not need to understand every term on a brokerage platform. And you do not need to wait until the market looks safer or the economy feels more stable. Here is the truth. Dividend investing is not about the size of your starting deposit. It is about the consistency of the habit. The person who invests $50 a month starting today will almost always outperform the person who waits 2 years to invest $500 all at once. Why? Because of one thing that no amount of money can buy back once it is gone: time. The math on compound dividend reinvestment is not complicated. It is just relentless. Every dividend you receive buys you more shares. Those shares generate more dividends. Those dividends buy more shares. It does not stop. It does not sleep. And the earlier it starts, the more unstoppable it becomes. A small number growing consistently beats a large number sitting still, every single time. And now I want to show you exactly how this works in real life, through someone who started exactly where you are right now. Zack was 27 years old, working a regular 9-to-5, and had exactly $83 sitting in a savings account that was earning him almost nothing. He was not broke, but he was not building anything either. Every month, money came in. Every month, it disappeared into rent, groceries, and the kind of small spending that adds up without you ever noticing. One evening, he came across a simple concept that changed the way he thought about money permanently. What if instead of spending that $83, he put it somewhere that would pay him to own it? Not a savings account. Not a high-risk stock he had to watch every day. Something that would simply send him money on a schedule, automatically, just for holding it. That was the first time Zack heard about dividend investing. The first thing Zack did was open a brokerage account that allowed fractional shares. This is critical for beginners. Fractional shares mean you do not need to buy a full share of a company. You can invest $5, $10, or $20 into a stock and own a piece of it proportionally. Platforms that allow this include Fidelity, Charles Schwab, and Public. All of them are free to open. No minimum deposit required. Zack opened his account in 11 minutes on his phone. And what he bought first is not what most people expect. This is where beginners usually make their first big mistake. Most beginners make the same mistake. They hear about dividend investing and immediately start searching for the highest yielding individual stocks they can find. Then they put all their money into one or two companies and hope for the best. Zack did not do that. Instead, he started with a dividend ETF. A dividend ETF is a single investment that holds dozens or even hundreds of dividend-paying companies inside it. When you buy one share of a dividend ETF, you instantly own a small piece of all of those companies at once. This means if one company cuts its dividend or has a bad year, the others carry the weight. Your income stream does not collapse because of one bad decision. Zack put his initial $83 into SCHD. That is the Schwab US Dividend Equity ETF. It holds around 100 companies that have consistently paid and grown their dividends over time. Low fees. Proven track record. Simple to understand. He did not try to be clever. He just started. But buying it once was not the move that actually built his portfolio. What he did next is the part most people skip entirely. Zack set a reminder on his phone for the first of every month, $50, every month, into the same ETF. Not because $50 was going to change his life immediately, but because the habit was the foundation. The consistency was the actual investment. In month 1, he had $83 invested. By month 6, he had roughly $380. By month 12, he had passed $700, including his first 4 dividend payments that he immediately reinvested. He never felt the $50 leaving. He adjusted his spending around it the same way he adjusted around any other monthly bill, except this one was paying him back. And here is the compounding moment that made everything click for Zack. Pay attention to this, because this is the part that changes how you see small numbers forever. DRIP stands for Dividend Reinvestment Plan. Most brokerage platforms have a simple toggle you can switch on that automatically takes every dividend payment you receive and uses it to buy more shares of the same investment. No manual action required. No temptation to spend it. It just compounds automatically. This is the moment Zack's portfolio stopped feeling like a savings account and started feeling like a machine. In his first year, he received $41 in total dividend payments. $41 automatically reinvested. Those reinvested shares then generated their own dividends the following quarter. By year 2, his dividend income had grown not just because he kept contributing, but because his previous dividends were now generating dividends of their own. That is the compounding loop. And once it starts, it does not stop. Now I want to show you exactly what this looks like over a 5-year period with real numbers. Because when you see this, the $50 starting point is going to look completely different. At $50 per month with an average dividend yield of around 3.5% and dividend reinvestment turned on, here is what Zack's portfolio looked like over time. Year 1, approximately $700 invested, $24 in annual dividend income. Year 2, approximately $1,500 invested, $52 in annual dividend income. Year 3, approximately $2,400 invested, $84 in annual dividend income. Year 4, approximately $3,400 invested, $119 in annual dividend income. Year 5, approximately $4,500 invested, $157 in annual dividend income. That is $13 of passive income arriving every single month by year 5, from $50 a month, without touching a single share. Now imagine what happens when that 50 becomes 100 or 200. The structure is the same. The math just scales. Zack did not get rich overnight, but he built something that no one can take away from him, a portfolio that pays him to exist. Here is something Zack told me after his 2nd year of doing this. The hardest part was not the money. The hardest part was not knowing where to start, not having anyone around him who understood this, and not having a consistent place to come back to when he had questions. That is exactly why this channel exists. Every single week, we break down real financial moves in plain, simple language. No jargon. No overwhelming theory. Just clear, honest breakdowns that working adults can actually act on. The people who subscribe and come back consistently are the ones who stop feeling lost about money and start feeling like they are finally moving in a direction that makes sense. And you do not need to figure this out alone. If this video gave you a clearer picture of how dividend investing actually works for a real beginner, hit the like button. It genuinely helps this video reach more people who need to see it. Subscribe and tap the notification bell so you do not miss next week's video, where we go deeper into exactly which dividend ETFs and stocks are worth looking at in 2026 for someone just starting out. And I want to hear from you right now in the comments. What is stopping you from starting your dividend portfolio today? Is it the amount of money you have? Is it not knowing where to open an account? Or is it something else entirely? Drop it below. No wrong answers. I read every single one and I will respond. I will see you in the next one.